Hello all, and thank you so much for attending week 3 of BFSG's 4-part summer webinar series, this week discussing healthcare in retirement. Let me pass it over to Paul for introductions.
Hi, everyone. Thanks for joining us today. My name is Paul Horn. I'm the Senior Financial Planner with Benefit Financial Services Group. With us today is going to be Brian MacArthur. He's a good friend of mine and honestly knows more about today's topic of planning for healthcare and retirement than anyone else that I know. So we're really lucky to have him. Brian, can you go ahead and introduce yourself a little bit more?
Yes, Paul, thank you for having me. You know, the one claim to fame I always make, if this even is one, is I often tell people they'd be hard pressed to ever meet anybody who's met more financial advisors in their life than I have. And what I've observed is that Medicare is the most overlooked topic within the financial plan for most financial advisors and their planning processes. That is not the case with Benefit Financial Services Group. So I just commend you guys for demonstrating leadership on this, you know, time-sensitive and complicated and deadline-driven topic.
Thank you so much. We're going to have a few polls throughout today's presentation. Chad, can you go ahead and kick us off with the first poll?
Yeah, thanks so much, Paul. So right now, for all of you, especially if you're new to our webinars, the first poll I'm going to kick off is really just thinking about the average spend that you might make in retirement. So I'm going to launch polling now. For all of you that are using your computer, unfortunately, it does not work for dial-in numbers on the phone. It should have just popped up. The question is, what do you think the average amount a couple has to spend for retirement or for healthcare in retirement? The answers are 150,000, 300,000, 400,000, or that's what Medicare is for. With that, I'll leave it up for about 10 more seconds as we gather responses, and then I'll close polling and share results with the group. So I think with most responses in, I apologize if you're just getting to the poll. Let me close polling, and then I will share results with the group. And so it looks like we have about 23% of you that say $150,000, 42% say $300,000, 22% say $400,000, 13% say, well, isn't that what Medicare is for? Let me stop sharing results. I'll give it over to Paul with the actual answer.
All right. So it looks like we have a lot of smart individuals here in the room. You guys understand that healthcare is going to be expensive in retirement. The cost projections for a 65-year-old couple today in today's dollars is they're going to be spending just on premiums $288,000. And then they're going to have on top of that about another $90,000 in out-of-pocket expenses. So out-of-pocket expenses are going to be things like your dental, your vision, your co-pays, for example. And these two combined numbers is $377,000. So about $20,000 shy of that $400,000 mark. For a couple that's age 65, just signing up for Medicare for the first time this year, you could probably budget for spending somewhere between $600 to $900 a month, depending on the coverage that you choose for Medicare. Brian, does that seem like a good estimate to you?
Yes. Yes, that's a good start.
Okay. And for healthcare costs, we know that healthcare is expensive, and we know that it's only getting more expensive. Why is that? Well, that's because healthcare premiums rise higher than the rate of inflation. So a study was done by Kaiser looking at healthcare costs from 2003 all the way through now. And what we saw over that 17-year time period that they looked at was the average healthcare premium rose over 200%. During that same time frame, inflation only went up 46%. Historically speaking, we've seen that healthcare costs tend to double the rate of inflation, and they grow at an annual rate of about 5% to 6% per year. Let's go ahead and get into the basics of Medicare. Brian, do you mind talking with us a little bit more about Medicare Part A?
Certainly. Thank you, Paul. If I may, just to start off, one of the things I always like to point out is that generally speaking, Medicare winds up being good to great news relative to the health insurance that we've all had prior to age 65 or prior to retiring after age 65. And that being said, and you know, Paul, we work hard to try to engage your clients typically at about age 64 for one big reason. Everybody's eligible for Medicare at 65. Not everybody enrolls at 65. 65 is not old anymore. And a lot of people work until it stops being fun, which is typically 66, 67, 68, 70, maybe, right? When you hear and think about Medicare, you really want to break this down into checking 4 boxes. So think of it as parts A, B, C, and D. You check all 4 of those boxes and you have a complete Medicare package. Like I said, the results are usually good to great relative to what people are used to. Parts A and B come from the government. Parts C and D come from insurance companies. So that's the first line in the sand I like everybody to draw. And then coming to your question, what is Part A? There's a lot of words here. Here's the way I describe Part A. I would encourage everybody to think about room and board, food and beverage at the crummiest resort you've ever been to, okay? Part A expenses are really exclusively, if you are hospitalized, it's the cost of the hospital bed, the 4 walls, the crummy food, the nurses who I hope are nice to you, okay? So it's the cost of being in the hospital. And if you think of it that way, you really don't need to memorize everything else. So think of this, it's room and board, food and beverage inside the hospital.
Thank you so much. There are a couple of fast facts I think is just important to know when it comes to Medicare Part A. The first part being there that the premium is free if you or your spouse have worked and paid taxes for 10 years or longer. The nice thing here is you can't be denied coverage. So it doesn't matter if there's any sort of pre-existing condition, you're still going to be guaranteed coverage. Anything else here you think that's worth talking about, Brian?
No, I think you really addressed it quite well, Paul. So again, we know hospital Part A is exclusively the cost of being in the hospital is the easiest way to think about this. And there is no monthly premium for virtually all of us for Part A. I would say it's free, but that is unfair to all the people on this webinar because you all paid for it out of your paychecks or your spouse's paychecks or both for probably 40 years or more. So that's why there is no monthly premium for Part A.
So let's go ahead and move on and talk about Part B here. Can you tell us more about that?
So again, if A and B come from the government and C and D come from insurance companies, we already talked about Part A, so we'll talk about Part B. Part B is really how doctors get paid and everybody who supports doctors, okay? So to give 2 examples, if you were in the hospital, you are racking up Part A expenses for the hospital bed, remember, because that's what Part A pays for, and Part B for the doctors and everybody who supports the doctors. If you're just going to see your doctor on a Thursday afternoon at a regular doctor's visit, maybe get some labs, tests, outpatient surgery, that is all Part B. So the easiest way to think of this is Part A is the cost of the hospital bed. Part B is basically everything else you'd ever need other than the hospital bed, which is all focused around doctors.
Yeah, the way I've always kind of thought about this is Part A covers if you're staying in the hospital. Part B is typically if it's outpatient where you're returning home the same day for the most part.
Correct.
And again, just some important things to know here for Part B. As we talked about, Part A is free, and it's hard to say free because, as Brian said, you've been paying into that for decades. But with Part B, there is going to be an additional monthly premium that you will be paying for Medicare Part B. We'll talk more about that premium in a few slides. Just know that that premium, if you are collecting Social Security, will come out of your Social Security paycheck. Again, nice thing here is you can't be denied coverage. So if you have any sort of pre-existing conditions, nothing to worry about for that. Anything else you wanted to add there, Brian?
Certainly. So, and you're going to find them. I always back up a little bit to come back to the explanation. So remember, A and B comes from the government. C and D comes from insurance companies. And we will cover this, I'm sure, in a subsequent slide. Once you have A and B together, That really covers about 80% of your medical bills from the government and 0% of your medications. Again, Part A has no monthly premium. Part B, and we'll cover this in a moment, does have a monthly premium. It's pretty modest for what you get. And even if your income is higher than the average American, a lot of times it's still a very good deal relative to the cost of insuring yourself, let's just say at age 64. Part B is really what makes Medicare operate. So some people who continue to work may just have Part A. If you have a friend that says, "Hey, I have Medicare," and they're still working and they're covered by an employer plan and they don't seem to know anything else about their Medicare package, that person typically has Part A. If you still have group benefits from an employer, Part A floats around in the background, doesn't do a whole lot for you, doesn't cost you anything, might save your employer some money, gosh forbid you're ever hospitalized. But Part B is when you're ready to fully go on to Medicare, you're enrolling in Part B.
All right, so we've got another poll here, Chad. Can you go and take it away?
Yes, sir. Thank you, Paul. So our next poll, I will launch it right now. So again, it should pop up on all of your screen for those of you on the computer, is what does Part A and B not cover? A big capital NOT for not covering. Dental, eye exams, prescription drugs, or all of the above? Okay, so with most responses looking like they're in, I am going to close polling. Again, I apologize for maybe getting to it at the last minute. And let me share results with the group. So we got 14% or less for dental, eye exams, prescription drugs, and over 80% saying Parts A and B cover basically none of the above. Let me give it back to you, Brian and Paul, to discuss the actual answers.
Looks like we have a really smart group here. You guys are all correct. For the most part, Medicare does not cover a lot of things. Does not cover prescription drugs. It does not cover routine dental, vision, or hearing care. Doesn't cover your eyeglass or your exams or your hearing aids. Doesn't cover things like cosmetic surgery, acupuncture, or dentures. So while A and B does cover a lot, there are some things that are not covered by it. Okay, let's go ahead and talk more about the Medicare costs. And particularly here, we're going to talk more about the Medicare Part B premiums. So as you guys can see here, based on what your income is for the previous 2 years, that's what is used to determine your premium cost for Medicare. So for example, if you're a couple and you make less than $176,000, you're just paying the base rate of $148 per person per month. You know, if you're single and you make $100,000 per year, your cost is going to be a little bit higher, about $207 per month. So you'll be paying about an additional $60 per month. Now, the reason for this is Medicare Part B has what they call a hold harmless provision. And what that states is this: once you're enrolled in Medicare Part B, your premiums cannot increase more than the raise that you get on your Social Security benefit. So for example, if you're collecting Social Security and on Medicare and your Social Security goes up by 2.5% 1 year, that means your premiums for Medicare Part B cannot go up by more than 2.5%. And as we talked about earlier, those medical costs are going up higher than the rate of inflation. So what's happening is those that are entering Medicare Part B later are having to pay the higher premiums as a result. And that's kind of how we get into this tiered system here. It is really important to understand how Medicare Part B premiums work, especially if you're doing advanced planning with things like Roth conversions, or maybe with your employer, you have stock options or deferred compensation programs, because all those sorts of things can impact the premiums that you're paying for Medicare Part B. Is there anything you want to add here, Brian?
Very good recap, Paul. Generally speaking, if you allow me to generalize, I will paint most of the participants on this webinar with a broad brush of calling everybody a good saver. So I bring that up because in order to be clients of yours, you pretty much have to be a good saver. But of course, if you're a good saver, oftentimes that's a result of having higher income than maybe the average American, right? So I actually, as I guide people through their Medicare education and actually executing to an actual result, I spend a lot of time on this particular topic because clients of yours typically have higher income. So first thing I usually ask people is, as we're looking at heading towards a Medicare enrollment, let's just assume I'm speaking to somebody now and they're going to retire at the end of the year. So they're going to start Medicare Part B on January 1, 2022, right? So 2022 will be the first year on Medicare. Social Security, who administers the enrollment and the billing for Medicare, is always looking at your tax return from 2 calendar years ago. So if I was speaking to a couple, for example, once I get to this topic, I usually say, look, I do not expect you to have this number memorized, but as if you're starting Medicare in 2022, Social Security will be looking at your modified adjusted gross income from 2020. Again, I do not expect people to have that number memorized on the spot, but even if you're shooting from the hip, most people can usually answer, whether they think their joint modified adjusted gross income from 2020 was over or under 176,000. I think it's worth noting that even what we would call very wealthy people in this country, a lot of people will come in under $176,000. That is a lot of money in steady Eddie retirement income, even if you have a very strong balance sheet. But the flip side of that is that a lot of your clients are typically at their highest income earning years at the end of their career. That's just kind of natural, right? And towards the end of a lot of people's careers, they wind up with these taxable liquidity events. So it could be that they're selling a business or a practice or exercising options, or they're forced to take deferred compensation, things like that. So these liquidity events, if they are taxable liquidity events, and a lot are, will spike your income towards the end of your career, right? So I live in San Diego County. A lot of people work for Qualcomm, and they might, you could have somebody that was earning, $150,000 a year for quite a few years, and in their last year when they retire, they earn $800,000. That may never happen again, but it did happen. And of course, as you can imagine, the bite that takes out of your finances when you go to retire and you notice that Social Security is treating you as though you make, $800,000 a year, when you're going to, that happened one time and it'll never happen again, and you will comfortably retire under 176,000. So long story short, the average American pays at least that $148.50 a month. Many of your clients will start off higher, or at least they'll get an invoice that could be up around the 386 or the 475 figure. That's not fun.
Yeah.
My next question, when people tell me that a taxable liquidity event like this has happened, is I like to find out, was that an anomaly, or is that going to happen all the time? And very often people reply, hey, I exercised options after working at, Qualcomm for, 22 years, never going to happen again. And then I say, okay, well, once the liquidity events are over, do you think you will be living on less than 176,000 in retirement? Even what most of us would call quite, wealthy people, a lot of people will still say yes, because that's still quite a bit of money in steady Eddie retirement income. So in other words, some people get this big, Part B bite on the way in, but it's very common that it will settle down as something more reasonable in the very near future. Some people will never get down that low, and they say, no, well, Paul says we'll never earn less than $210,000, right? So we just try to set expectations for what Part B is going to cost them over time. Even if you do retire And in 2022, they're looking at your 2020 income that is, this anomaly event that is big, will never happen again. And you get this big, ugly invoice. I do like to point out to people right here and right now that if you are no longer earning that much, Social Security is actually quite reasonable. There's a form called SSA 44 where you declare a life-changing event and you fill it out. And basically what you're saying in this very short and easy to fill out form is, hey guys, address to Social Security, please stop looking at my 2020 income. That was the result of me retiring, stopping working. That's work stoppage is the most common box that we check to declare the life-changing event. And you're saying, please stop looking at that gigantic, income number in 2020. And then you make an argument for what you think you're going to earn in 2022, which again, not always, but often for a married couple, even in, Southern California, not that all your clients are there. It's very common that people will say, hey, I don't earn 600,000 every year. We're going to earn 140 this year. And as a married couple, that would literally bring you from almost the highest Part B income tier to the lowest. So it's very worthwhile to uncover with clients, especially if they are exposed to those higher premiums, what their current income looks like, because we can get out of that bigger Part B premium almost immediately in most cases.
Yeah, and with that SSA 44, if you think this does apply to you, we've actually put the link in the chat. So you'll get that. And if you get a copy of the notes here, there'll be a link here that you can click on from this slide to get direct access to the SSA 44 as well. All right, so we've talked about the basics of Medicare here. Let's talk about the ways to get additional coverage, okay? And when you look at the different Medicare options out there, I would describe it as this. Essentially, when you put a destination in your phone, let's say I'm trying to go to a new place in LA that I've never been to before. I'm going to type that into my phone, the address, and the maps is going to give me 2 or 3 different routes that I can take. They're going to end up at the same spot, but I can take 2 or 3 different ways to get there. With Medicare, it's really the same thing. You're going to get Medicare, you're going to get medical coverage. It's just depending which route is going to be best for you. So Brian, can you talk to us a bit more about those routes or those choices they have when it comes to Medicare?
Certainly, and I spend most of my days using this exact slide as a visual aid. So again, backing up for a moment, remember a full Medicare package. Let's think of that as parts A, B, C, and D. A and B comes from the government. C and D comes from insurance companies. For those of you who maybe have done some research on Medicare, you may catch me cheating a little bit in how I explain this. There's no consequence to the way I cheat on it, but I'll let you know when I'm cheating because I'm just trying to make this simpler. So as we look to the left part of the screen, remember A and B comes from the government. Part A, Part B, once you have a Medicare ID card in hand with parts A and B on it, that is the federal government telling you we are going to pay 80% of your medical bills and 0% of your medications. So the government gets you pretty far down this road. Remember, Part A has no monthly premium for the reasons we talked about before. Part B, the average American pays about $149 a month. And some of you might pay more to start. Some of you might get bigger invoices that we'll be able to appeal our way out of almost immediately. I'd say even with high income, most of you will pay $149 a month. Some of you might pay more if your income is consistently higher than that $176,000. So if you'll indulge me, let's just assume that as we look at step 1, that's 80% of your bills paid by the government for $149 a month. Okay, again, there'll be isolated events where some of you will pay more. As we look at step 2, the old version of the slide had A and B on top and C and D below, but we'll just work with this. Paul, if you can maybe draw an upside or just trace kind of an upside down V between the there you go, from there up and down. So basically, I'd like you to imagine a fork in the road. There's 2 ways to address parts C and D. Thank you, Paul. Perfect. Now, here's where I'm going to cheat. Oh, look at that. Perfect. It's the benefit of working professionally.
Drawing skills, please.
Oh, That's better than me describing it. So that's perfect. So I'd like you to think of this as a fork in the road. Whichever path that we take, you will be solving this with insurance companies. I'm going to cheat a little bit and call both sides Part C and D. You might notice that on option 1, it's called Medicare Supplement in Part D, and the other side is C and D. I personally cannot resist the temptation to alphabetize. So I love describing this whole thing as, A, B, C, and D. So regardless, as we look at these two options, this is not a good versus evil comparison. Both options are quite wonderful. They are probably, in any case, potentially as good and likely even better coverage than you're used to while you're working. So whichever path you go, whatever you do for Part C and D, and I'm cheating again, I'm calling Medicare Supplement Part C, but whatever you do for Part C will be an insurance company saying, hey, we're going to step in and pay the 20% of your medical bills that the government did not cover. So if A and B covered 80% of your medical bills, think of Part C as covering the other 20%. That rounds you out to about 100% health insurance coverage. And anytime you see or hear about Part D, just think D is for drugs, okay? So, so the two paths, one path is, let's call that option 1, is using a Medicare supplement plan. And the other path is called a Medicare Advantage plan, okay? Paul, let me know if I'm jumping ahead of what you wanted me to cover, but I'll just keep explaining this until you.
Well, yeah, we can go. Why don't we go ahead and go to the next slide, and we'll talk more about option 1 here.
Okay.
Only thing I would throw in real quick is just, you may have heard the term Medigap. Medigap is the same as Medicare Supplement. The term is synonymous.
And if you can, before we move on to the next slide, if I may, because I think the next slide coming up is Medicare Advantage, which is fine. Generally speaking, I might make some exceptions to this, but as we go into these next slides, for now, I would like you to think of Medicare supplement plans, which are synonymous with Medigap, as Paul pointed out, will usually look and feel like the sexiest PPO plans imaginable. So that's what Medicare supplement plans feel like. And then Medicare Advantage plans usually look and feel like the sexiest HMO plans imaginable. Now, there are examples in different parts of the country where I might sprinkle in some PPO options on the Medicare Advantage side, but just for now, just so that you can keep this straight in your head, just think Medicare Supplement, sexy PPO, Medicare Advantage, sexy HMO, and I'll present some exceptions to that. But that's just in an effort to try to turn complicated topics into something simpler. I just wanted to add that in.
All right, so let's start with Part C.
Okay, so Part C, this is the true Part C. Let's call this Medicare Advantage. Remember, this was option 2 in the previous slide. So Medicare Advantage plans, generally speaking, feel like magnificent HMO plans, and in parts of the country where they do have PPO options are still pretty good PPO options. Just to create that bookend for 2 bookends for a moment, let's talk about Medicare Advantage in the context of HMOs, just because that gets us to that extreme. And again, I'll sprinkle in the exceptions in a moment. So with Medicare Advantage plans, first thing I'd like to point out is that in most cases, Medicare Advantage, to address Part C and D, have no monthly premium. Remember, the government's involved. So when you hear no monthly premium, that does not mean crummy insurance. It's actually magnificent insurance. There's trade-offs to everything, and we'll cover the trade-offs. But Medicare Advantage, almost all the time, you are paying no additional monthly premium for Parts A and Parts C and D. So this is a good opportunity for me to point out that Joe Namath is not lying to you when you see those commercials in fourth quarter every year. So Medicare Advantage plans have no monthly premium. It's still magnificent coverage. In many cases, there are always very, very good HMO options if you live in a major metropolitan area. These plans actually work out very, very well. So I'm just going to use San Diego County as an example where I live. It's far from the only example, but in San Diego County, Medicare Advantage plans are almost always HMO options. You would only choose a Medicare Advantage plan that your primary doctor and their medical group accepts. It's usually one or two insurance companies that have a contract there. And your primary doctor, you'd want to think of your doctor as your quarterback in football, right? All things go through them. So in order to see a specialist, they have to refer you to a specialist. They will always refer you to a specialist in their home team medical group or the specialist group that they normally use. If you're in a major metropolitan area, Los Angeles, Orange County, Denver, Colorado, being limited to one medical group is probably not that limiting. However, just keep in mind, what's not going to happen is you're not going to pound your fist on the table and say, I heard that the best left toe orthopedist for me is in Atlanta, Georgia, and I'm going to go. Unless you live in, Atlanta, Georgia, and that orthopedist is in network and referable by your primary doctor, you don't really quite have the same autonomy to go. Now, generally speaking, most of us would just want to go to the specialist that our doctors suggest, but just understand with a Medicare Advantage plan, particularly if it's an HMO plan, you have a primary doctor who's kind of quarterbacking what specialists that you go to. So that's if it's an HMO. All Medicare Advantage plans have co-pays for virtually everything. Those co-pays are pretty nominal, and you're happy to pay them because you have no monthly premium. So that's kind of what life looks like on a Medicare Advantage plan. There are some PPO options in different parts of the country. Also, you might notice on that slide that you may have seen some of those dental and vision options. I know it sounds strange that a zero premium insurance policy that costs you nothing, that's great, also might offer some dental and vision, but in certain cases they do. That typically exists on the Medicare Advantage side. So again, I wouldn't get too excited about those things just yet. But if you wind up in a Medicare Advantage plan and it works out with your network of doctors, you could find yourself getting some hearing, some vision, some dental, chiropractic, that sort of thing. Okay.
Talk a little bit about Part D.
Okay, and Part D, I'm going to go through this quickly. You're going to wind up with Part D regardless of which path that you go, right? So with Medicare Advantage, that zero premium plan that we talked about a moment ago, Part D will almost always be built into that policy. So you'll have one ID card that covers Part C and D. Yeah, so there you go. So you'll wind up with Part D in both cases, was my point. Yeah. Okay. Yep. Excellent. So now if we think back that original slide with the upside down V, as we talk about Medicare Supplement or Medigap, these plans will feel like I said, the sexiest PPO plans imaginable. So what does life feel like on a Medicare Supplement plan? Well, you keep all the doctors you know and love, and you still are probably inclined to go see the specialist that your primary doctor suggests. However, if you do want a second opinion from a specialist at a different medical group across town, across the county, out of the state, that's okay. With a Medicare Supplement plan, you can go literally anywhere in the country without a referral. So as you think, as I called it, like this sexy PPO, you can go anywhere you want without a referral. So to most of you who've been on a PPO, you'd say, yeah, that feels like a PPO. A Medicare Supplement plan is actually even better than a PPO in one particular way. Regular PPO plans will often let you go anywhere you want out without a referral, but PPO plans have in-network providers and out-of-network providers. Generally speaking, for those of us who are used to PPOs, we're usually trying to stay in-network because that's where the lower copays are. You can go out-of-network with a real PPO. Most of us who have a PPO still try not to do that because it costs more, right? A Medicare Supplement plan is even better than what all of us know as a PPO, in that there are no networks. So that doctor in Denver, Colorado, if you live in Houston, Texas, will actually not cost you any more or less to see, sorry, I got a little blurry here, than the doctor in your hometown. So if your life depends on it, you literally could go see any doctor in the country. Quick example, I had a friend that I set up with a Medicare Supplement plan. He lived in Palm Desert and he wound up with throat cancer, and he picked up and moved to Scottsdale, Arizona for 4 months, rented an Airbnb, and because he wanted to be treated at Mayo Clinic. You can do that with a Medicare supplement plan.
Excellent. So again, just touching on some of the fast facts here. Nothing really new, as we've already talked about. So
Right.
we've got these different options. The question becomes now, how do you choose between those two, that fork in the road? Is it the left or the right that's better for you?
Right.
Really, it's going to come down to 3 different things. You need to consider the type of coverage that you're looking for, the cost that you're willing to pay, and the convenience that you're looking for. So Brian, can you talk to us a little bit more about these 3 considerations?
Right. And one of the things that's probably worth starting is that Medicare supplement plans do have monthly premiums, where remember Medicare Advantage plans typically do not. Just to paint a broad picture here, I would say that the top, not the only, but the top version of a Medicare supplement plan with any insurance company in any part of the country is typically called Plan G. You want to think of G for great. And I'm just going to talk pricing on this again, just to set the other bookend. Broad brushstroke, Plan G or Plan Great in most parts of the country runs, $130 to $160 a month for Plan G, where and again, you go see any doctor you want in the country, and you almost never see any bills. As we think Medicare Supplement versus Medicare Advantage, well, Medicare Advantage costs nothing for Part C and D. Medicare Supplement usually costs, let's just say, $150 a month. An extra Part D drug plan might run 20 or 30. So let's just say cost-wise for Part C and D with Medicare Advantage is probably $0. Medicare Supplement, if you do the plan Great, it's probably, let's say, $170 a month. So that would be one consideration, right? What do you get for paying that monthly premium if you chose Medicare Supplement? The ability to go see any doctor on your terms without a referral. State lines don't matter. You almost never see bills. The flip side of that was Medicare Advantage is that you can use a magnificent HMO. You might have some PPO options in your county, have no monthly premium. You're reaching into your pocket every single time because there's a copay for everything. They're not gigantic. But you do need to be mindful of either your HMO or PPO network. Finally, again, I know it's this wacky world of Medicare where the option with no monthly premium, Medicare Advantage, is actually the one that actually has a chance of providing some of those benefits that we covered earlier that Medicare does not cover. Maybe a little bit of dental, a little bit of vision, possibly acupuncture, possibly free transportation to your doctor, those sort of things.
Perfect. Yeah, and I think what you touched on before with that story is so important, because really one of the big insiders, and I've talked with clients in the past, has been their health history. Someone that's really healthy, maybe goes to the doctor for their wellness checkup once a year, doesn't have a family history of anything, they take good care of themselves. Maybe that HMO, that Medicare Advantage, makes perfect sense for them. But if you have an ongoing condition, maybe like an ongoing heart condition, or there's a family history or something that you want to have that flexibility or make sure that you're able to choose the providers that you're choosing, that in and of itself may be a good starting point for which of these 2 roads to go down.
Right. And if I may add one other thing, Paul, it's just worth covering, is that when the time comes for anybody, if they want Medicare Advantage, you got it. We just enroll people in it. Medicare supplement plans do ask health questions, which means you can be accepted or declined. But if you're brand new to Medicare Part B, which either you will be when you turn 65, if you're going on Medicare at 65, or maybe 68, enrolling in Part B for the first time because now you're retiring, you have guaranteed acceptance rights. So there is a little bit of a bird in the hand dynamic to consider. If you choose Medicare Supplement to start, you're guaranteed to get it. Nobody can ever drop you. That's what that guaranteed renewable means. If you started with Medicare Advantage to start, candidly, you'd probably be really happy with it for quite a few years. Typically, once people start getting into their mid 70s, it's usually when the client or one of us is nudging the other in the gut and saying, hey, should we just be grateful that we got away with no monthly premiums? for 6, 7, 8 years, maybe while we're still healthy, because somebody who started with Medicare Advantage will likely have to answer health questions to get Medicare Supplement down the road. So, if Medicare Advantage feels good to start, I would say go with that. But just realize we may have to answer health questions later. You probably want to answer those health questions. Better chance that they say yes to you at age 72 versus 82, right?
So when do you enroll for coverage?
Okay, excellent. So, I always joke around and say that they keep Medicare just complicated enough that I always know I'll have a job tomorrow, which is a terrible thing to feel grateful for. And a lot of the mail and marketing material you get, especially starting at age 64, 1 year before you're eligible, is just designed to scare the stuffing out of you, and it kind of drives me nuts. But it's all around, penalties, deadlines, consequences. Folks, all of that stuff does exist. I'm going to say it's more possible than probable. Most of you, if you're only half paying attention, will really not have to worry about late enrollment penalties. I'll go through a couple easy examples. If you're turning 65 and if you're ready to go on Medicare at age 65, you will be utilizing your IEP, or initial enrollment period. Really what that is all focused around your 65th birthday. You can start the process to enroll in A and B through Social Security. For those of you who don't yet have a username and password, to ssa.gov. I'd encourage you to get that, because we enroll in Part A and B online. Also, usually while I'm in there helping people do that, I usually point out to people that, Paul or Chad, I apologize, it's a hotel room phone. Let me pick that up and hang that up rather than make you endure that. One moment.
Yeah. So really with that IEP, that initial enrollment period, it's a 7-month window. So you get 3 months prior to the month that you turn 65, and it ends 3 months after you turn 65. So.
Right. And people hear a 7-month period. To convert it to reality, Paul, virtually everybody is dealing with this in the 3 months prior to age 65. Yeah. Okay. So really, if your birthday was so 3 months prior is when you can start making decisions. People usually like hearing about it prior to then, but 90 days out, you can enroll in A and B. Once you do that, a few weeks later, you get your Medicare ID card in the mail. Once you do that, the tough part's done, and it's not even that tough. But you just need to get the government enrollment done so that you can move forward. So that's the IEP. The general enrollment period, I'm actually going to skip over because it's really not going to do anybody any favors. Special enrollment is the other period. What's the special enrollment? Well, that's somebody who's been working at their company and they decided to work till age 67, right? So now they're about to retire. Then they'll enroll in Part B. And because they're new to Part B and they're losing employer-sponsored health coverage, things like that allow them to continue their Medicare enrollment outside of the annual enrollment period. So I do get the question from people here and there that say, gosh, I really want to retire June 30th, but does that mean, should I work until the end of the year? Because I won't be able to enroll in Medicare until, whenever you decide to retire is going to trigger a special enrollment period for us to enroll you in Medicare. So my point to people 65 and up is work until it stops being fun. When you're about 90 days out, then your decision will one moment. ¿Puede regresar? Okay, gracias. Okay, and I'm meeting. All right. Sorry. Your decision to retire will trigger your timeline to enroll into Medicare.
So looking at some financial planning considerations for helping pay for healthcare and retirement. Number one, as we've talked about here, you really want to start doing the planning sooner rather than later. You don't want to be talking to someone like myself or Brian 3 months before you turn 65. You really want to start that planning process when you're like 63, just turning 64. Give us a better time to help you get prepared. We also want to look at ways to help avoid, that gives us more time to also find ways to make sure that we're reducing your income for things like Medicare premiums Part B, and that you're being well prepared there. Now, in terms of helping pay for these costs, a couple ways to do that. Number one, the best way is to maximize your Roth strategies. So this could be making Roth contributions into like a Roth IRA, Roth 401k, or maybe even Roth conversions. And hopefully you guys listened to the webinar last week as to why we're so big on Roth versus traditional. If you didn't, I would really recommend that you listen to that replay, because that does really fit. Understanding that really does fit into how beneficial it is to help pay for things like healthcare in retirement. As we talked about before, if you're doing the Roth conversions, like let's say you retire so you don't have the same income and you want to do the Roth conversions, just making sure that you're working with a financial planner. So that way you can understand how it impacts your Medicare Part B premiums, and you can do the Roth conversions in a way where it's not actually increasing your premiums. That's what's called a fill the bucket approach, for example. Now, aside from that, if you have access to what's called a health savings account, HSA is the more common term, definitely would recommend that you put as much in there as you can. The money goes in there tax deferred, the money grows tax free, and it's actually tax free for healthcare expenses. And the great thing about the HSA is you can put money in there while you're working. The money can actually be invested in mutual funds. And then you can actually wait to use that money to help pay for your healthcare costs in retirement. So once you start collecting Medicare, you can no longer contribute to a health savings account, but you can use the health savings account to pay for the premium or pay for the out-of-pocket expenses related to your Medicare coverage. So let's go ahead and transition to talk a little bit more about understanding long-term care. Chad, I believe we have our last poll here.
We do. So I know there is only a few more slides as we're running up on time before we get to the Q&A, but there has been a couple questions on long-term care. So I think this is a perfect segue to conclude on. But the poll, I'm going to launch it right now. It should, again, for all of you on the computer, pop up on your screen. I'll leave it up for about 20 seconds. But how do you plan to pay for long-term care? Option one, I have long-term care insurance. Option two, from my investments. Number three, that's what my kids are for. And number four, I thought that was covered by Medicare. And with most people that haven't responded, let me close polling. I, again, apologize for any of you. They're just getting to it at the last moment. And I will share results. So again, we have about 18% saying I have long-term care insurance, about 62% saying I'll pay for it from my investments, 6% having fun, saying that's what my kids are for, and 17% thinking that Medicare would have covered this. So let me stop sharing results. I'll pass it back to Paul and Brian to discuss the actual answers.
All right. So long-term care has evolved considerably over the last decade or so, I would say. In the past, it was really just getting care, leaving your home and getting care somewhere else. The reality today, and this is good news for most individuals, is that most of the long-term care is actually done in the home setting. Really about 80% of the time these days, that's in-home care, whether it's at that person's home or maybe a family member's home. Now, aside from receiving the in-home care, there are some other options using what's called an adult daycare. So maybe you're in a facility during the day and then with a loved one at nighttime. There are care facilities out there. There's what's called skilled nursing, or where you maybe need a nurse on site 24/7. And then finally, there's what's called hospice. Now, in terms of paying for long-term care, there is long-term care insurance that can be bought. And if you have it, that's fantastic. As showed by a lot of you guys from the question that we just had there, sounds like most of you guys are actually planning on self-insuring and instead paying with it from personal assets. Aside from that, Medicare can kind of touch on it. But the other big one, especially here in California, is called Medi-Cal. So if you need the coverage and you don't have a lot of money, you could actually qualify for getting federal assistance. It's known as Medi-Cal here in California. Outside of California, it's referred to as Medicaid. So, I know, Brian, you have a lot of experience here. Anything you want to add?
So typically, as we're concluding a Medicare enrollment, one of the things I always like to do is just chat about whatever topics did not come up along the way. Long-term care is often one of them. A few things I always like to point out to people is that Medicare, especially with a Medicare Supplement or Medicare Advantage plan, will typically cover up to about 100 days in skilled nursing, which is terrific because skilled nursing is very expensive. It's kind of like a hospital with a lot fewer doctors, right? Two things I like people to think about, though, is that number one, if you ever do have a long-term care event, it will almost certainly be longer than 100 days. And number two, to Paul's point, there's a lot of nice facilities you can go to. Everybody wants to be at home until they can't be at home, right? So it's hola, ¿puedes regresar? Gracias. Okay, I'm sorry, I'm in a hotel room. So so everybody wants to be at home. So typically know that what I find is that the most worthwhile topic to address with the financial advisor of the client who I'm working with, if is long-term care, if it's been addressed or not. Now, I would never villainize, self-insuring or paying out of personal assets. There was a time way back when where you either self-insured or you bought traditional long-term care insurance for some reasons that maybe Paul might address better than me. You pay premium, not everybody got excited about it. Typically, for people who are good savers, there are ways to leverage the same assets that you would typically self-insure with in ways that, Paul and Chad and everybody could chat about better than me. But I think it's important to have a plan no matter what. And in the absence of insurance, I think that conversation starts with, hey, Paul, if I need long-term care tomorrow, what assets are we going to liquidate first? Without stepping over my skis, I can speculate it's probably not going to be your best performing, funds or stocks. It's probably going to be the safest part of your portfolio that you would spend down first. And, in ways that, Paul is much more suited to maybe comment on. I know that there are ways to leverage those same assets that, you would spend first on long-term care into being worth way more from a, way to leverage. So bottom line is it's important to have a plan. And I just find personally that a long-term care planning conversation, if it's yet to be addressed by the Medicare enrollment, is probably the next most worthwhile one to have between financial advisor and client.
I would completely agree with that. When we're doing financial planning for our clients, we certainly spend a lot of time here looking at it. At the end of the day, with long-term care insurance, we look to see, number one, if that event happens, is there the ability for the person to pay for it or not on their own? So first off, do they have enough personal assets where they can pay for it if they choose to? If the answer is no, we're typically going to look at trying to get some form of insurance. If the answer is yes, they can pay for it out of the personal assets, then the next question that we ask and we take a little closer look at is, well, if something does happen, do you want to pay the bill or do you want someone else to pay the bill? If you want someone else to pay the bill, that's another time that we'll look at the long-term care insurance. And if you are looking at long-term care insurance, there's two schools of thought. A lot of people will say get it when you're as young as possible, so that you're most likely going to qualify for it and the premiums will be lower. Now, the downside to that is you'll be paying into something that you may not use for a longer period of time. The average age for long-term care when that coverage is needed is around age 72. So if you get the policy when you're 55, you may be paying into it effectively almost 20 years before you get the benefits from it. Now, there's another school of thought that says wait until you're older, like maybe your late 60s, early 70s, and get it then. The premiums may be higher, but you're paying into it a lot less. So you should get more bang for your buck theoretically if you need it. Downside there, though, is you may no longer qualify it if you wait too long. So it's a conversation that you really need to have with a financial professional if you're looking at that to kind of determine the amount and the when and the how. And the policies went from really good to about 10 years ago not being so good. And that pendulum's kind of swung back to the middle where you can actually get a pretty good policy these days if needed. So just looking at the average cost for long-term care, if you're going to work, if you're going to stay at home and have someone come into your house, the national average is around $4,500 per month. Here in California, that number is going to be higher. If you're looking at an assisted living facility, that cost is $4,300. So it's actually about the same cost as having someone in your home. And then finally, if you need a skilled nursing facility, that cost is going to be higher. A semi-private room is going to be a shared, like typically you're going to have someone else in your room with you. That's going to be about $7,700 a month. If you want to have your own private room by yourself, you're looking at almost $9,000 per month for the cost there. So you can see that long-term care costs are not cheap. This is why it's important to have that plan together and have that conversation like Brian mentioned earlier. So long-term care planning is not fun. In fact, I describe it like peeling an onion. You're going to have to get through several layers. And if you're not careful, it's just going to make you want to cry. The first layer to that onion is really understanding your individual risks. You know, what does your health look like? What does your family's health history look like? You know, dementia and Alzheimer's are by far the leading causes for the need for long-term care. So if your family has that history, you're certainly going to want to be doing additional planning around that. Things that you can be doing is making sure that you take good care of yourself, and not just making sure you eat right and you are exercising, but make sure you're taking care of your mental and emotional state as well. Make sure, you know, if there's trauma, if there's stuff going on, that you're getting help, that you're not trying to do things on your own. Make sure that you talk with your loved ones. So if you want to stay at home, that's great, and everybody typically does. But the question is, who's going to take care of you? Is that going to be a spouse? Is that going to be a child? So you're going to need to talk with them to understand if they have the capacity and the willingness to be a caretaker. So you may have a loved one that wants to take care of you, but maybe doesn't have the skill set to do so. In my own family right now, we're going through this with my mother-in-law. She's only 64. She has dementia. We started the process where my father-in-law was taking care of her. My father-in-law is hands down one of the nicest, greatest guys that I've ever met. Top 2, top 3 of just, I absolutely love him. I couldn't say anything bad about him. Loves his family to death, loves his wife to death, always does whatever he needs to do to take care of them. And watching him trying to deal with that on a day-to-day basis, he was trying to take it on by himself, and it was just too much. And while he's a great man, he does great things, he's a great husband, a great father, being a caretaker was not his best skill set. So it actually was a lot better for him and for the care that my mother-in-law was receiving once they brought in that home health aide to come into the house and help them. And that transitioned to a living facility, which is now a skilled nursing facility. So it is really important to just have that plan in place and talk with your loved ones, because as much as they may have good intentions, they just may not be able to provide you the care that you need or deserve. So it's really important to understand that. You need to understand the potential costs. If you can't self-insure, then you need to look at maybe getting that in policy, or maybe doing some planning in case it happens where to qualify for Medi-Cal. Really, all of this is what we're trying to do at the end of the day, is trying to stay ahead of the curve, meaning if something happens and we need a transition, that you're not doing it when it's too late, but there's a plan in place ahead of time. Brian, anything here that you would want to add?
No, I think those are appropriate comments, Paul. The one thing I would say about Medi-Cal or Medicaid outside of California is, will they pay for your long-term care costs? Yes. Do they need you to be entirely broke? No, they do want you to be mostly broke. Now, what I mean by that is there are ways to protect some home equity, but on liquid assets, you need to be down to virtually nothing. There's a couple illiquid assets you can keep. There's a much deeper skill set that I'm not claiming to have, but just generally speaking, you know, if you have equity in your home, In a lot of cases, that can be protected while you're alive. You're allowed to have a car. You're allowed to have like $2,000 in the bank. From a liquid asset standpoint, you need to be mostly broke. So I would go as far to say that, as your net worth in liquid assets, approaches $1 million and beyond, Medi-Cal is probably not going to happen for you. I would say the people who benefit most from Medi-Cal or Medicaid taking care of the long-term care costs either never had any liquid assets to start with, or maybe they had a more modest amount of liquid assets. But the higher your liquid net worth gets, it doesn't take long for Medi-Cal or Medicaid to not really be your most ideal option, or at least to. So I would just bring that up just to paint a picture of when Medi-Cal and Medicaid does work for people. If I'm going to generalize, I would bet it's unlikely to be a viable option for most people on this call. But I just kind of paint a line in the sand just to know what to expect.
Typically, where I've seen it in the past is either someone that had that $1 million and they've been in the care facility for a while, and so they've spent down that $1 million. So like Brian said, things like a primary home is a protected asset. You can keep that and go on Medicaid, at least here in California. So instead of maybe selling the home to pay for that care, you can do planning to get onto Medi-Cal instead and be able to still keep that home. So there is planning around stuff like that can be done, potentially. Well, I want to thank you everyone for listening to this. In just a few seconds, we're going to transition and start taking the questions. If you have any questions and you want to reach me directly, please feel free to email me at financialplanning@bfsg.com. We also have Brian's contact information here as well. If you would like to talk with Brian or maybe review your policies or anything like that with Brian, his email is brian@designmymedicare.com. Next week, we are going to be talking about the future of retirement in America. We're going to have another very special guest speaker, a former advisor to the Speaker of the House. Sorry about that. That's going to be next Thursday at the same time, 10 a.m. If you want to reach out to us and get a copy of our free Medicare Quick Reference Guide, please feel free to reach out to us at that email at financialplanning@bfsg.com. With that, Chad, I'll transition to you for questions.
Awesome. Thanks so much, Paul and Brian. So the first question, gentlemen, is for Medicare Part B, premium penalties for late enrollment. I'm still working. Spouse is 65 and signed up for Part A already. He's also covered under my employer group plan and is the primary. There isn't any penalty if he continued to be covered under my plan until I retire and we both sign up for Part B. Is that correct?
Yes, that's correct, Lisa. As long as your employer has more than 20 full-time employees, everything you said is correct. If your employer has under 20 full-time employees, you would want your husband to enroll in Part B as quickly as he can to avoid late enrollment penalties. I'm going to make an assumption your employer has more than 20 employees, which means you're just fine to do what you're doing.
Awesome. Next question is, what if your income changes from one tier to another after you've enrolled and you're already taking these benefits? Right.
So coming back to that, Social Security is actually quite reasonable about this. If your income did change, and let's just say most of the time your income is dropping, the government is kind of clunky, right? And by their own admission, they just say, hey, we look 2 years back because if we're, if it's February, nobody's filed their taxes from a year ago. So we always look 2 years back because everybody should have filed their taxes by then. So they just say, hey, we're looking 2 years back. If you want to bring to our attention that your income has dropped and you can claim it is as a result of one of these qualifying events, there's 7 qualifying events, the most common. And when I say most common, 98% of the time, I'm having people check the box that says work stoppage, which is another word for retirement, or reduction in work hours if you're still working, which I think would be impossible for them to ever want you to document. So if your income goes down, it's well worth filling out that form, faxing in his Social Security, and getting them to consider reducing your Part B premium sooner than the 2 years that it would naturally take them.
Awesome. So the next one, guys, it's going to come partially from the chat box, partially from the Q&A box. Is can we please explain the Part B premium penalty for late enrollment? And do you have any insight on how that penalty is calculated?
Yeah, so, again, there's a difference between probability and possibility. Obviously, if you're asking about the Part B late enrollment penalty, perhaps you're worried that you're exposed to one. Most people are not, but the two things I would say is that a Part B late enrollment penalty, if Medicare Part B costs $148.50 a month for the average American, let's just call it $149, and you went, let's just say, 2 years without Part B, which most people don't, but there are cases that people find themselves in that situation. And now you enroll in Part B, you would pay your $149 for Part B, plus a 10% penalty, which is $14.90, times the amount of years you did not have Part B, let's just say 2 years. So really, it's a lifetime monthly penalty. Is it gigantic? No, but instead of paying $149 a month for Part B, you'd pay about another $30 a month in lifetime late enrollment penalties for not having Part B for 2 years. So your $149 a month would really be more like about $179 a month. It's not going to break your financial plan, but it is a lifetime penalty, and it's 10% of the standard premium times the amount of years. So we like to avoid that, because who wants to pay penalties? Most of you will successfully avoid them, but that's how it's calculated.
So our next question is, sounds like this is specific to Los Angeles. Sounds like we have a few people from LA. So I don't know that you'll have the exact answer, but can you please discuss medical insurance options considerations for people in LA retiring before age 65? Additionally, should I use an insurance broker? And if I do I pay for that, or is that cost paid by the ultimate insurance company?
Yeah, good question. So if you're retiring prior to 65, you're going to.
Typically at that point, you can buy private insurance on your own, because you won't qualify for Medicare until age 65. What I see most of my clients that retire early do is they go on the state exchange. And so with the state, you have different levels of benefits depending on, again, how much coverage you're looking for and the type of coverage. Same thing there of HMOs versus PPOs, and how much do you want to pay, from a high deductible plan to a Cadillac type of plan. They're all there. So that's most commonly what I see individuals do. It's very easy. You can do it right on the website. If you do work with a broker, correct me if I'm wrong on this, Brian, but I believe they're typically paid by the insurance company. So there's typically not an additional cost an individual uses by paying to use a broker.
Right. There's no incremental cost or difference in cost, whether you use one agent versus another versus going directly to the insurance company or on the exchange. Your biggest opportunity for price advantage would be if you're, again, we're back to modified adjusted gross income. Now you're predicting it in the year that you are. Most of your clients, again, are good savers. Most of the people on this call don't anticipate qualifying for many government programs. The dirty little secret about the Affordable Care Act, which in California we call Covered California, is that those premium subsidies, where the government's paying for some, most, or sometimes all of your monthly premium, are entirely based on income, have nothing to do with assets. So depending on what your income is going to be in the years that you retire, between retirement and age 65, there could be very strong incentives to work with, Paul or Chad or your financial advisor to take advantage of any taxable income malleability that you have. So in other words, there are ways that you could talk to Paul about maintaining the cash flow you need in retirement, but maybe in some cases, Paul or Chad might have some autonomy to keep your taxable income low, which would mean you might get pretty healthy premium subsidy that would make your health insurance
We
a
have
lot
a few clients right now that we've helped with that. Absolutely.
yeah. So
So the next question is, can you switch between supplemental and advantage during open enrollment times?
So typically open enrollment, the easy answer is yes. You can always move from an advantage plan to an advantage plan during open enrollment. You can always move from a supplement plan to an advantage plan during open enrollment. You do want to keep in mind that if you did not choose a Medicare, if you chose a Medicare Advantage plan when you were new to Part B in most cases, you'll need to answer health questions to get approved for a Medicare supplement down the road. But typically it is during the open enrollment period that we would do that. So remember, you have guaranteed acceptance into the Medicare supplement if you choose it immediately. If you did Medicare Advantage, they're still very, very wonderful plans. You just have to know that the potential consequences that 4 or 5 years later, if you wanted to move from Advantage to supplement, you'll likely need to answer health questions.
So next question, it sounds like we have a couple people in here that have an age difference between them and their spouse. So we'll say, call it 12-year age gap. I'll be on Medicare well before my spouse. What are the best options to consider for health insurance coverage for my spouse before they turn 65, assuming they no longer have employer provided health coverage?
Right. So very quickly, Paul and I kind of just covered this. Number one, always take a look at the COBRA offer. COBRA is your employer saying, hey, your spouse can keep this coverage that they've had. It's just that we used to pay most of the premiums and you paid a little bit as an employee. Now you're not an employee. You can keep it, but you have to pay, the full premium. For a lot of people, they go, gosh, that's really expensive. I like this wonderful PPO at $200 a month out of my paycheck. I'm not so excited about paying $1,000 for a month, and my spouse never goes to the doctor anyway. So if the COBRA offer is not appealing to you, then you go in the individual family market. And again, I'd say the best case scenario is these days there's been so much government stimulus. A lot of money has been poured into the Affordable Care Act. So a lot of people that never qualified for premium subsidies now do. So you would just look at all options. If COBRA works, I would say that easiest thing to do is that. But a lot of times COBRA is very expensive relative to people's use. So then we would look into the state and federal exchanges, Covered California or healthcare.gov.
So our next question is along similar lines. My spouse carries our health insurance and plans to work until about 67. Should they apply for Medicare when they turn 65, even though they'll still have employer health benefits?
Right. So I get this question all the time. Technically, you're supposed to enroll in Part A. Let's assume this employer has more than 20 full-time employees. If less than 20 full-time employees, you should enroll in A and B at 65. There's problems and penalties for not doing that. Let's assume there's over 20 employees. Technically, you're supposed to enroll in Part A at age 65. Most of the time, you're happy to do it. Be a good Boy Scout or Girl Scout. Doesn't cost you anything. Doesn't really do a whole lot for you. If you were ever hospitalized while you're working, your employer health plan might save a little bit of money before they paid the hospital bill. They'd say, well, let's see how much Part A covers. I find the biggest advantage of enrolling in Part A, even if you're at 65, even if you're going to keep working and stay on an employer plan, is just the ability to not be accused of doing nothing at age 65, right? So my biggest fear is you're at a barbecue and somebody says, you didn't enroll in Part A at age 65, and they scare the stuffing out of you, and it's a Friday night. You can't get a hold of me until Monday to tell you it's going to be okay. The other thing I will mention just very briefly is that for most people, we enroll in Part A at age 65 in that set of circumstances. If you are contributing to a health savings account, which Paul had mentioned, a lot of people do that quite enthusiastically. The moment you enroll in Part A, they're going to stop allowing you to make employee contributions to Part A if you enroll in an HSA. There's a few more complicated nuances that I don't have the audacity to go into right now. There are times where if people are enthusiastically contributing to an HSA, I would advise against enrolling in Part A. But if you're not contributing to an HSA, most of the time we just enroll you in Part A.
Okay, guys, so the next one is, it doesn't have a thumbs up, but I got a couple things in the chat box on the exact same thing. So, and then there's also a comment about long-term care. Somebody says, they're 59, and would their money be wasted if they signed up for long-term care now, or better to wait until age 65? And somebody else that has just in their own personal experience, you've had their parent who never really needed it for 25 years, paid into it, and they found out that there's a lot of restrictions when they finally needed it.
Yep.
What are your thoughts on, is it actually worth it, especially if you're in decent health, and rather than investing the money instead and trying to self-insure down the road?
So you really need to do a comprehensive financial plan and take a look at your individual risk factors to fully answer that question at the personal level. But I would say this, getting the insurance, if you can afford it and it makes sense, is not a bad idea. Like I said, there's two schools of thought. One is get it earlier while you're healthy and just pay into it for a longer period of time potentially, but you're going to have a much lower premium. The other one is wait, but if you wait, you risk not qualifying for it. So getting the policy early is not a bad thing to do per se. And secondly, the policies today have changed immensely compared to what they were 10, 15, even 5 years ago. A long time ago, the policies were what are called indemnity policies, meaning they worked like auto insurance. If you used it, it was there, but otherwise you paid into this thing and you saw no benefit from it. Today, there's a lot of hybrid policies. So they're a long-term care policy, but they're built on either an annuity or a life insurance policy kind of attached to them. So worst case scenario, you're going to get that money back, or your heirs will receive that money as in a form of like a life insurance death benefit. So the policies today are much better than they used to be. So you don't have to worry about paying into this thing and not getting any value for it per se. And as I mentioned earlier, the policies went from being really good to being really bad, to now they're back more in the middle to being good to really good again. So, if there was problems with the policy not being good, I'm guessing they got that policy probably when that pendulum swung from one side and it swung too far to the other side. Brian, anything you want to add there?
I think, to just summarize what you said, the days of only having, use it or lose it options are kind of behind us. Again, that was the deals. You paid into this thing the whole time. If you needed long-term care, it would usually pay, substantially, but you could find you paid into it your whole life and you never needed it. And, you could say the same thing about car insurance, but those long-term care insurance premiums are usually pretty expensive. So you'd feel that more. Again, generally speaking, for good savers with liquid assets, I think who should be naturally tempted to self-insure, just say, hey, Paul, here's the safest part of the portfolio. We'll spend this $100,000 down first. I think it's the trade-offs to repositioning those more highly safe and liquid assets into one of these hybrid policies. It's an easier conversation all the way around. I would just encourage you to, chat with Paul about it, because he understands it quite a bit. But the days of the use it or lose it dynamic kind of over. The industry, I think, has responded to that. Additionally, I will say that part of that whole pendulum that Paul talked about is that, a long time ago, insurance companies priced these things wonderfully because they didn't understand the risk that well. It's not cool to die anymore. So long-term care events happen quite a bit. And then the industry kind of wound up on the insurance industry wound up on the wrong side of that. So then they kind of contracted quite a bit. Candidly, Paul, I don't know your 2 cents, but I think the cognitive impairments really caused the biggest opportunity for mispricing. You had a bunch of insurance companies trying to be very competitive to capture this business. But then suddenly these cognitive impairments can run, they could be like 8-year claims. So when all the claims kind of came in, the insurance industry kind of contracted. There's still way fewer insurance companies interested in this risk than there were 20 years ago. But to Paul's point, it got down to a very small amount of insurance companies. And now that I think the risk is better understood, there's more competition in the area, which has kind of, the more competition, the better the benefits have gotten from the client, to benefit the client. So it just really requires a much longer, a more in detailed conversation with, Paul.
And just kind of a disclosure here, guys. We don't sell long-term care here. So if one of our clients actually needs the policy, we refer that out. So this is not something that we're trying to pitch or sell. So I just want to make sure that that's very clear on this webinar today. We are fee only as a firm.
So our next question, gentlemen, is you're thinking about the income for the year before to determine your costs for Medicare is, well, what should that income be used to determine what my cost should be? Like, why should the income for that 1 year be used to determine what my cost should be?
This is back to Medicare, right?
Yes.
Again, the government is just taking a snapshot of your income to decide, are you going to pay the average amount for Medicare Part B, or are we going to charge you more for it? They're kind of clunky, so they're looking 2 calendar years back, and of course, that's 1 year more than 1 calendar year back, so there's a better chance that number might not be reflective of how much you're earning now. But basically, they punish you for having higher income, right? And they're always going to calendar years back. So in 2024, they're going to look at your 2022 income. 2025, they look at 2023, and then it's up to you. I'll tell you, nobody's going to miss an opportunity to identify it's a good idea to fill out SSA 44. Besides, the communication I give to people, the government's pretty transparent with that, and they say, here's your premium. If you disagree with it, let us know. Fill out SSA 44. They're not trying to hide it. I called Social Security earlier in my path to become a specialist in Medicare, and I was having a conversation with a representative from Social Security, and he said, we're not trying to stick it to anybody. We're just we're looking 2 years back, because everybody's filled out their tax returns 2 years ago, not always 1 year ago, and we're happy to have people tell us that they're not earning that much anymore, and adjust your premium down accordingly.
So I think this goes like really hand in hand with that. I'm gonna do the next 2 questions together. I think they tie perfectly what you just said. So is the premium for Part B recalculated on a yearly basis based on your income? And you're noting that incomes can change over time, and can you end up in a lower bracket for premiums once not working full time?
Absolutely, yeah. So it's common that your income goes down in some denomination once you retire. So yeah, if you do nothing every year, they're just going to look 2 years back, right? And if 2 years back is a lower income or in a lower income tier, then the calculation they did the following year, they'll automatically move it down. If they see that your income went up, they'll automatically move it up. Obviously, you're not going to complain if it goes down. If it starts off high or if it goes up high, you will notice it. They will communicate that very clearly. And a lot of people call me, Social Security is very good about communicating. If you disagree with this number, if this is not reflective of your current income, let us know.
So our next question, which we may have already answered, so it should be a very quick response here, is can you join Medicare Advantage on a yearly basis, or is it a one-time choice when you join Medicare?
Yearly.
So the next one is I am 67 and currently on my company's health plan, which I generally liked. High deductible plan with HSA, continues to build up. Eventually, I'll transition to Medicare. I'm confused in how one does this if they have an HSA. I've been told you need to stop paying into it several months in advance. Can you explain how someone like me should plan to transition to Medicare from a high deductible HSA plan?
Right. So I'll say this quickly. So here, as you approach retirement, in the interest of time, I will tell you, during your open enrollment period, in the year prior to you retiring, I would cease making contributions to your HSA account. Long story short, when you're ready to go on Medicare, Part B, C, and D will start on the day that you want it to. Part A, they will backdate 6 months for a reason I can't even explain. And what that would do is that would invalidate the tax deductibility of your previous 6 months HSA contributions, and then get you with a little bit of a penalty. So as we sit here in July, if you thought you were going to retire, late 2022, early 2023, I would just stop the HSA contributions for 2022, and that should be fine. The penalties would not kill you, but most people like to avoid penalties. So that's about as much as without knowing more, that's about as much as I could say about that right now.
So the next one, I have a few questions on this. So it's not at the top, actually. I'm going to pull from a few different areas and dismiss them all. But I've heard of Part G. Can you explain what it is and how it relates to Part C and D? And in addition to that, does Part G have a lifetime cap? Do you know where that might be? And then do the Advantage plans have a lifetime cap?
Okay, so and let me just scroll up and down just so that I make sure. Was that an anonymous attendee or
That was.
Okay. Okay, if I missed something, please just let me know, Chad. So remember I cheated and I called both sides parts C and D. Okay, so Medicare Supplement, which was the sexy PPO option. The top option is called Plan G. Typically, I like to call that Plan Great because if I start talking about Plan G to address Part C, our heads will explode, right? So Medicare Supplement, the very highest option is called Plan G. Let's call it Plan Great. What does life look like on Plan Great? Again, it's a Medicare Supplement. Go see any doctor in the country. No referrals, no networks. Every Medicare Supplement is like that. Plan Great is the highest option. What's life look like? You would have a $203 annual deductible. Pretty much your first doctor's visit every year is on you because I'm sure it'll cost $203, right? Once you pay that $203 once a year, though, you'll pretty much go the rest of the year every year without ever seeing a doctor bill or hospital bill. So without you having to be a health insurance expert, most of you could probably deduce that if you can go see any doctor in the country, no referrals, no networks, pay $203 once a year, and then you don't see any bills, that's about as good as health insurance could get in 2021, right? You still have co-pays for your medications, but anyway, so that's Plan G or Plan Great. That's the highest Medicare Supplement option. As far as annual caps, really with a Medicare Supplement, or let's say Plan G or Plan Great, $203. You'll write a $203 check each year, and then you won't see any bills. On a Medicare Advantage plan, those plans, remember, those have no monthly premium. Those do have annual out-of-pocket maximums. They range across the country. They're typically lower in Southern California, where the population is very dense. They get a little bit higher in other parts. Could be, $2,000, $3,000, $4,000, $5,000, $6,000 as an annual out-of-pocket max on a Medicare Advantage plan. Typically, the only way to get a bill big enough to hit the out-of-pocket maximum cap on a Medicare Advantage plan is cancer. Cancer will get you to the annual out-of-pocket max quickly. Other than cancer, it is darn near impossible to get a bill that big. So I tell people not to freak out too much about the out-of-pocket maximum because it's not very rare that people get a bill that big.
So
I may have missed.
So the next question, guys, and it goes back to self-insuring for long-term care. So I'm about 60 years old. I live in LA again. Have a spouse a few years younger. I've heard that there's certain net worth levels that it might not make sense to purchase long-term care. Is there a net worth that you could kind of, as a rule of thumb, say that you would recommend not to purchase it? Like 20 million, 30 million. What is that net worth?
That one's a hard question to answer because the other side of that equation is how much are you spending each year? I mean, we've seen plenty of celebrities and athletes show us you can make $1 million a year and still be broke. So it's really hard to say what that number should be for net worth without knowing what the spending habits are each year. If you have $10 million, that's great. But if you're spending 500 grand a year, that's not going to be enough. If you have $10 million and you're spending 60 grand a year, yeah, you can self-insure at that point. So it's unfortunately, I don't have a rule of thumb or something that I could say there to really answer that.
So the idea is you want to talk with your advisor, have a financial plan done, and have them kind of back into what your expected expenses are. And based on your net worth and your expected expenses, they'd be able to tell you whether you should self-insure or not. So the next one is, I've been hearing about income determining how much you might pay for Medicare. So according to Social Security statements, making, call it $85,000 a year for the last decade. In the year before I turn age 65. What if I did a Roth conversion of $100,000 that would boost my income? Does that money count towards income and put you in a potential different tax bracket that year for Medicare?
The answer here is yes. So if you're at 85,000 per year, and let's say you're just single, you're going to be at the 148. If you do that conversion of 100,000 in your example and you're single, your combined annual income now becomes, you're with those two, when I say combined, I mean the 100,000 plus the 85, assuming you work the full year, that's 185,000. You've gone from $148 in premium all the way up to $475 in premium. If you do this one time, as Brian has said many times, fill out that form SSA 44, you might be able to get that reduced. If you haven't, otherwise, you're going to be paying that for at least that 1 year. If you're doing, let's say, a conversion of 100,000 every year going forward, that may bump you up a bracket. So if you're considering doing Roth conversions, a good approach to use is what I call a fill the bucket approach. So let's say you're a couple and your annual income in retirement is 100,000. Well, you could take 50 or 75,000, do a Roth conversion each year. That's going to take you to the top of this bucket here at 176, but that's not going to put you above it. So it's not going to increase your premiums. So that's that fill the bucket approach I had mentioned earlier.
Okay, so the next one is just confirming that we do not need to enroll in Part B until they leave their employer. Is that correct?
As long as your employer has more than 20 full-time employees, that's correct.
So the next question is, this came in really early in the presentation, as we were talking about, you have $400,000 for a couple. I'm guessing that goes back to how much a couple can expect to spend in healthcare, be it premiums and out of pocket. Do you guys have any idea what that statistic might be for a single person?
Cut it in half, 200.
Got it. Easy. And so next question is Part B premium based upon income at the time you go on Medicare or at the time you retire? So especially thinking if you're retiring early, like maybe you're retiring at age 55 or so.
Just 2 calendar years back. They're always looking 2 calendar years back, and then it's up to you to change their view if that's no longer accurate.
So the next question is, my spouse or husband is on permanent disability at age 65 and has Medicare Part A and B in addition to being on my company's health plan. We're unsure of how we can use Medicare with Kaiser and haven't gotten good answers from Kaiser. Does it matter as long as he's on my company plan?
They probably have a Kaiser Permanente employer-sponsored health plan. If everything's working okay, then they probably don't need to do anything. I mean, you could look at if the employer had a Kaiser Permanente Medicare Advantage plan that they wanted him to go on, you could have that conversation. I would only do that if it looked like better benefits than what he has now. I'm guessing if he has A and B already, that I would say if there's a benefit improvement, you might put him on a Kaiser Permanente Medicare Advantage plan and opt out of the employer plan. But you'd want to. Personally, I'd want to look at the Medicare Advantage benefits and the current employer health benefits and just weigh them against each other. And if one, it might make her grateful to have her husband in the position she's in, or you might just say the heck with the company benefits and go right onto a Kaiser Medicare Advantage plan.
So next question is, if you were to retire in October this year, 2021, will Social Security look at the 2019 or 2020, your last tax returns, to determine Part B premiums?
For the balance of this year, they'd look at 2019, and then 2023, next January, they would start looking at the 2021 return.
And so this goes back to that SSA 44, premium bump due to single event, like we've already talked about. If it's going to correct within the next 2 years, though, do you still need to do a SSA 44?
Well, I would, because you're usually filling out SSA 44 to get your monthly premium from like $475 a month down to $148. So there's usually very good math for you to fill out that form and submit it. I wouldn't wait I wouldn't wait and pay higher premiums if you think that submitting SSA 44 could make those premiums go down immediately.
Next question is, if a higher earner substantially reduces their earnings by working part-time for 2 or more years before officially retiring, will the premiums be lower than if they stayed full-time until retiring?
Yes. Yeah, and then the other way that kind of flips is, if you look at the screen that's up right now, you'll see that there's not much of a difference between the $475 and the $504, right? So, answering a question you didn't ask, but if you did have a sizable liquidity event to come in, once you get to about once a married couple gets over $330,000, you may as well harvest $3.3 million in gains that year, from my opinion, because you're kind of pretty close to maximum punishment. So anything over, let's just say roughly 330,000, you're not really punishing yourself from increasing your Medicare premiums. So, there's different times that you'd want to harvest more gains if you're already at maximum punishment, and especially if that would help you reduce your income below 176,000 in other years. So, and one of the ways to do that would be working, part-time.
Next question is, what type of plan would be best for couples that travel overseas a lot, like supplemental PPO, the Advantage HMO? And then similarly, we have another question in the queue is, does Medicare vary state by state? So not necessarily overseas, but state by state. Okay, so Medicare from the federal government standpoint does not vary state by state. It's all the same. What does vary is the offerings of Medicare Advantage plans. They tend to vary more state to state, county by county. I'd say the more of a metropolitan area that you're in, usually the better the Medicare Advantage plans are. The more rural you get, the less good Medicare Advantage plans get. And if you get really rural and non-metropolitan, they don't even have Medicare Advantage plans. Medicare Supplement plans, pretty much the benefits are the same. It really comes down to price, and all that's kind of county specific. So I'm sorry. And then the other question is for traveling overseas. Medicare Supplement plans, back to the sexy PPO, those do include, by Medicare mandate, a pretty sizable international hospitalization benefit. It's good enough that most of my clients, I shouldn't say most of my clients, a good portion of my clients don't even buy extra insurance. There might be some gaps in risk, but it's good enough that some people don't buy anything extra. Medicare Advantage plans are very plan specific. Some offer international travel benefits, some don't. And yeah, that's my answer on that.
So it's better if you're traveling a lot overseas.
So we maybe answer this, but somebody came with a question again. They may have missed it earlier. Can you switch at some point from Supplement to Advantage and vice versa?
You can always go from Supplement to Advantage. You may have to, I would set the expectation, if you want to go from Advantage to Supplement, you'll probably have to answer health questions to get approved for the Supplement, because you did not choose the Supplement immediately on the way in. The health questions are not awful, but there are ways. The insurance companies do not want to step in front of moving traffic, right? So if you're right in the throes of cancer, they're going to pass on you. If you slid into second base in the over 60 softball league, you tore your meniscus, it's in your medical records, you need surgery and you haven't had it yet, they're probably, they think there's a big bill coming in the near future, they would pass on you. But that's my answer.
So then next question goes back to the income test. Is it a one-time thing, or are they constantly reassessing premiums annually?
Yeah, constantly reassessing annually, and every year they're looking 2 calendar years behind, right? And then if you disagree with that, you would fill out SSA 44 to bring your current income to their attention if the number that they're looking at from 2 years ago is not reflective, and as a result is charging you more than you feel you should be paying.
So then next question is, can you briefly touch on health plan options for people that may plan to retire early, like well before age 65?
Right. So again, we would normally look at COBRA, just evaluate it, see if it's palatable to you. If it's not, then we go in the individual family plan market and either look for a more lean plan, because so maybe what you were used to at work was the equivalent of a gold or platinum plan, but you only paid a small amount as an employee. On COBRA, they would charge you a ton for that. And you might say, I can get away with a bronze plan because I never go to the doctor. and save some monthly premium. That would be one option. The other option would be, I'd usually try to find out what you think that your current household modified adjusted gross income is likely to be. And if you give me a response that is low enough that I think it's worth applying for individual family health insurance through Covered California or healthcare.gov, then we would go down that road and see if we can get subsidized health insurance.
Cool. And so we just got a couple of more questions. So the next one is, if you're under your spouse's employer medical plan, do you still need to apply for Part A at 65 or just wait for Part B until your spouse is also retired? Would that be a good way to save?
Well, you won't save any money because Part A doesn't cost you anything. So it really doesn't matter whether you enroll in Part A at that moment or not. Again, a lot of people like to do it so they can't be accused of doing nothing. Part A doesn't cost you anything, doesn't do a whole lot for you. Your employer appreciates you enrolling in it. So, sometimes we enroll in Part A. It's not terribly consequential if we wait until later. It's not consequential.
Next one is, if I can afford the Plan G, is there any reason not to take it?
No, I mean, it's really about as good as health insurance could possibly get. Now, when I say that, that's not to villainize. There's no heroes and villains here, right? So it's not like Medicare Supplement good, Medicare Advantage bad. Medicare Supplement is about as good as health insurance gets, has a monthly premium. From Medicare standpoint, Medicare Advantage has no monthly premium. You got to live within those HMO, PPO networks. One of the advantages, you might wind up with a little bit of hearing and vision, maybe a little bit of dental. But generally speaking, if you allow me to generalize, if I were to speak to, 100 clients of you guys, I try to present both options agnostically, just so people understand the trade-offs. Not that anybody has to care what the larger group of people do. I would say clients of yours, usually 6 out of 10 to 7 out of 10 go with the supplement because, or they feel like there's a monthly premium, but it's not that much. And then the other, 30 to 40% do the Advantage plan. And even those people at some point might migrate over to supplement.
So the last 2 questions that we are going to take for today. Next one is, I retired and am paying for COBRA coverage for my family. My wife just got a job though. Will we still qualify for COBRA if she enrolls in her job's healthcare plan?
COBRA is individual. So if your wife enrolled in her employer plan, my gut says that you guys could stay on COBRA. Unless her former employer is subsidizing the COBRA premium. Sometimes that happens, usually not. Generally speaking, I would imagine you guys would race onto your wife's new employer plan because it's probably going to be less expensive than you paying full price on COBRA. Probably the best thing to do is contact the COBRA administrator once the rest of the family is eligible for group insurance and find out if COBRA is going to mandate that you go onto the group coverage or not. I think you can choose to do either, but I would ask the COBRA administrator.
Agreed.
So then the last question we have for today is a little bit specific. Do you happen to know if LA Unified School District teachers are eligible for Medicare?
Absolutely eligible. Keep them, and this common question, understand that Medicare is its own government entitlement, Social Security is its own government entitlement. You apply for Medicare through the Social Security Administration, but you don't need to be, they're just doing the work for Medicare, right? So typically an LA Unified School District employee is not eligible for Social Security benefits, but they're absolutely, they've paid into the Medicare system. So they would enroll in Parts A and B, when they retire or turn 65. And then I'll wrap up on this because at LA USD, there's a good chance that the union has negotiated some sort of group retiree Medicare Advantage option. So anytime I come across somebody who worked for a union or they work for a big company like ExxonMobil, I always kind of send them back and say, hey, we still need to go through all the things we covered in this webinar today. But when we go through Medicare Supplement, Medicare Advantage, I want you to go back to your employer or former employer and find out if you've earned any Medicare options. And then we compare that to what the regular Joe can get off the street. Sometimes a district option is better or the same. Other times it's the same and more expensive. The answers are all over the place. So we just evaluate it. But bottom line is, if somebody has earned a group retiree Medicare option, I always want to fully investigate that. The last thing I'd ever want to do is make a recommendation that somebody goes on this Medicare Supplement or this Medicare Advantage plan, and then we find out 2 years later we overlooked some great benefit that they were, spent 30 years earning. So I always like to dig deep and just understand exactly what benefit they earned. Sometimes it's better, sometimes it's worse.
Awesome. Well, guys, thank you so much for your time today. Especially staying on after a great, about an hour-long presentation, staying on to answer all of the questions we had in the queue today. Again, for all of you attending, thank you so much for joining us today. We hope you found the presentation and content today from Paul and Brian meeting everything you're looking for. Please definitely reach out. There will be PDF slide decks. I did paste them into the chat box again. In case you have any questions for Paul or Brian, their contact information is in there so you can reach out directly. Thank you all for your time, and we hope you all have a great day.
Thank you for having me.